Hello, everybody. Welcome to today's webinar brought to you by Bursa Malaysia Derivative and managed by our company, LifeChamp. Today, we are very excited to be doing this topic that is titled Managing Profit and Loss in the Volatile Gold Market with Gold Futures. Okay, so today our topic is gold futures. How do we trade the gold market with the gold futures? So that is our specific topic in this evening. So before we begin, allow me to give you the disclaimer. Whatever we share in this session is only for educational purpose. So in no way that will give you any recommendation for you to buy or sell any listed securities or derivatives that we mentioned. So if you decide to make any investment or trading decisions, you're 100% responsible for all your investment and trading risks. Now, today we are very honored to invite Dr. Arif Zainuddin to come to our session to talk about this gold futures. As you know, gold market has been extremely volatile, and Bursa Malaysia Derivative launched the revamped gold futures contract for you to profit from the volatile market. So this will give you an exposure to the gold market through a futures contract. So today we have got Dr. Arif Zainuddin, who will talk about this topic. So allow me to briefly share with you about his background. So Dr. Arif Zainuddin is currently a futures broker representative under Phillip Capital Sdn Bhd and a licensed medical doctor under Malaysian Medical Council. Throughout his years of experience in trading, he has accumulated wealth of knowledge of which he shares with his clients and the public to achieve consistency and succeed in trading high-risk instruments. He has conducted seminars and workshops on futures trading and was also one of the guest speakers on FCPO and FIPO topic for Bursa Marketplace Virtual Fair 2022 in July this year. So that is a very interesting background, isn't it? Okay, we have a medical doctor coming to share with us about trading gold futures, and he's a remisier under Phillip Capital Sdn Bhd. So welcome to today's session, Doctor.
All right.
Thank Dr. Arif.
Yeah, I can hear you.
How are you?
I'm doing great.
All right, fantastic. So I will pass the floor to you, Doctor.
All right. Okay. Thank you so much to Shane as the host for tonight. Assalamualaikum warahmatullahi wabarakatuh and good evening to everyone. Can you hear clear?
Yes, can hear you.
And the participants? All right. Okay. So 1 second. I'll share my slide. Okay. So can everyone see the slides? Is there any issues?
Yes, we can see your slide.
Okay. So as I mentioned, thank you so much to Shane for hosting us tonight, and also to Bursa Malaysia for inviting me to be presenting on this topic with regards to the newly launched contract of gold futures back in September 19th. So tonight we will be learning on the topic of how you want to manage your profit and loss in the volatile moving asset of gold using the new contract under Bursa Malaysia under BMD. Okay, so first of all, as per the disclaimer that Shane just mentioned just now, I would like to put the disclaimer myself as well that the contents, any advice or recommendations are from my personal opinion, and trading futures contract falls under high-risk investment. So you do seek advice from qualified financial advisor, and you should consider whether the investment product is suitable for you or not. Okay, so before we start our session, how many we have here? For about 80 plus. I need to know sort of like the demographic of our participants tonight. How many of you have traded futures before? How many of you have traded futures before? I believe the most one of the most famous futures contract that the public knows is the crude palm oil futures, FCPO. Okay, right, Mr. PK Lim, not yet. He used Nisam Sutin. Okay, so never. Okay, so we learn about futures first before we go into the gold futures itself. Okay. All right. So what is futures? So before we go into futures, we need to see what are the things that are offered under Bursa Malaysia derivative. There are three categories of derivative contracts. Okay, so what under Bursa Malaysia, you have one part that is doing on the equities. Okay, and then there's another part of the Bursa Malaysia. Okay, the subsidiary of Bursa Malaysia, which is the Bursa Malaysia derivative, offering a different kind of instrument as compared to the equity that you have under Bursa Malaysia. Okay. So what do you have under Bursa Malaysia derivative? You have a lot of three types of the derivative contracts. Okay, which you have the commodity derivative, the equity derivative, and the financial derivatives. If you remember from what we had recently with the promotion that is being done by Bursa Malaysia, especially on the virtual trading challenge. Any of you have joined the virtual trading challenge under Bursa Malaysia? They're doing a great job to promote on the futures trading. So next year, if you haven't got the chance to join the virtual trading challenge under Bursa Malaysia this year, you can still join it next year. Okay. So what is the under the derivative branch under the Bursa Malaysia, right? What is the most popular? FCPO, okay? Futures crude palm oil. How many of you have traded FCPO? So under commodity, you have the FCPO, you have the FEPO, okay? The East Malaysian crude palm oil, you have FPKO, you have USD tin futures, you have options on crude palm oil, and then under the equity you have FKLI, okay, FTSE Bursa Malaysia KLCI futures, and then you have the FM70. I think recently Bursa also did a challenge on FM70. They just released their list of winners, so congratulations if any of the winners that joined this webinar. And then you have another branch of it, which is the financial derivative, which is the CLIBOR, Kuala Lumpur Interbank Offered Rate futures. Okay, but what about for the retails, for retail investors that are joining tonight? What are the things that are available to you to trade? Okay, as you know, we have the FCPO, which is a very liquid and high volume contract that has been traded since 1980 plus. Okay, and then you have this another one, which is gold. Okay, gold futures. All right. So what is the difference between the gold futures and the FCPO? For those that has traded FCPO, right? What is the difference? And we're going to see, I think Mr. Guan will mention one of the things, right? It's liquidity. We're going to see it directly on the chart later. Okay, but before we go into the trading of the gold futures itself, we need to understand what is futures. Because as I screened earlier, I see that a lot of the participants have never traded futures before, probably those never heard about futures trading, probably never heard about FCPO. So we're going to learn from the beginning first. Okay, let's make it simple and easy, because it's Tuesday night anyway. Okay, so what is futures? It's based from forward, actually. Okay, so it's based from forward, and then from forward it is improved in a few ways, and then it becomes futures. So what is futures? Futures is basically, it's a standardized agreement made between two parties. Okay, whether probably it's between Abu and Ali. Okay, an agreement between Abu and Ali to buy or sell the underlying asset. Like for example, if you take agreement on the FCPO, what is the underlying asset? The asset is CPO. Okay, crude palm oil. If you made an agreement on the gold futures, what is the underlying asset? The underlying asset is gold. Okay, and what it does is to buy or sell, making an agreement to buy or sell on a specific date in the future for a predetermined price. Okay, do you guys understand what it is? Do you get it? Okay, so it's basically Abu and Ali making an agreement to buy gold, but to lock the price earlier, or probably depending on the contract that they have agreed to, probably settling for the price 4 months before getting the asset. Okay, it's probably too technical, but I think we will go as we go on through the webinar. You understand it better. Okay. All right. So what is FGLD? Let's learn a bit about FGLD. Okay. So FGLD, okay, gold futures began trading in Bursa Malaysia in 2013. Okay, on 7th October 2013, and then it was suspended on 24th March of 2021 to undergo a revamp of the contract specifications. And then on 19th September, they relaunched back the FGLD. We revamped on the contract specifications. And then recently, actually on 5th December, which is yesterday, okay, yesterday, the trading hours of FGLD was extended from 11:30 p.m. extended to all the way to 2:30 a.m. Okay. And what is the objective of doing introducing this newly revamped contract of FGLD? It's to seize the opportunity to enhance the FGLD's attractiveness for investors with all the revamped contract specifications, and then to alleviate the foreign exchange fluctuation exposure between USD and ringgit. Okay, so let's learn a bit about what are the key changes for the new FGLD contract compared to before it was suspended and now. Okay, so the current contract multiplier it's 40 per contract unit, and the contract size is all right, the contract size is one contract unit equivalent to the reference price per troy ounce multiplied by the contract multiplier, which is 40. Okay, the price quotation before the revamp, it was quoted in ringgit, but now it's quoted in USD per troy ounce. Okay, so the trading hours is from Monday to Friday. It goes from 9 a.m. all the way to 12:30 p.m. and then 2:30 p.m. to 5:30 p.m. and then for the T+1 session on Monday to Thursday from 9 to 2:30 a.m. Okay, so what is the how do you calculate the tick movement in FGLD? So the minimum, which is the minimum price fluctuation, you see that USD 0.1, the tick movement in FGLD is USD 0.1 per contract unit. Okay, so the value per tick movement is equivalent to 4 ringgit. We will see this clearly on the chart later. So every movement, every tick movement of 0.1 with the fixed multiplier of 40, every tick movement equals to 4 ringgit. Okay. If you've traded FCPO before, the tick movement is 25 ringgit, right? So FGLD, the difference is the tick movement, for every tick movement, it is equivalent to 4 ringgit. Okay. So the underlying asset of the FGLD is its gold set to a minimum of 995 fineness. Okay, and the settlement method is by cash settlements. It's not by physical settlement. And the contract multiplier is 40 per contract unit, as mentioned earlier. And the important thing that I want to highlight here is this one. This is the margin for the FGLD. Okay, so if you know what is the margin for FCPO, for those who have traded FCPO, it's 10,000 ringgit, right? RM 10,000 ringgit for one lot. For the latest one, latest revision by Bursa, the margin for FCPO is 10,000 ringgit. But for FGLD, the margin for FGLD for one lot is 1,700 ringgit. Okay. Okay, so the price settlement, the settlement of the contract FGLD is based on the ICE benchmark administration gold reference by the LBMA AMUSD. Okay, all right. So how do you calculate the final settlement value for the contract? Is you it's based on the LBMA AM fixed price, right? For example, we take this one 1794.4. Let's say it's 1794.35 per troy ounce. The final settlement price is always rounded to the nearest 0.1. Okay, so in this case it will be 1794.4. So the final settlement value in ringgit is 1794.4 times the multiplier of 40, which you get the 71,776 ringgit. Okay, so how is it calculated in terms of profit and loss? Okay, like for example, let's say you in the scenario of it's a bearish trade, you make an analysis. That the market is going down, for example. So you're taking a short trade, a bearish trade. So let's say the price is at 1777.7, and then you sell one lot, and then you buy back again at 1750.5. And how much did you get is this one. Okay, from this calculation, you minus from the price that you sell, and then you minus to the price that you bought back again. 27.20 times with the multiplier of 40, you get the gross profit of 1,088 ringgit. Okay, and the whole P&L, okay, profit and loss, is not impacted by the USD and ringgit exchange rate. So throughout the entire fund flow from trading to clearing, clients do not have to convert ringgit to USD at all. Okay, now let's look at the chart. I think a number of people are saying on the chat FGLD is not getting a lot of volume and trading interest. Okay, so well, let's see the chart itself, because at this point of the webinar, we've already had probably about 2 months. Okay, about 2 months of trading on gold futures. Although I admit that there is not a lot of volume that you're seeing on gold futures, but we'll see what how we can get from the trading gold futures. Let's say you make let's say you analyze your chart. You analyze your chart, and then you see that the chart is probably going bullish. Okay, going in a bullish movement, and you want to enter a long position. Okay, so let's say you entered a long position on November 8th. Okay, November 8th at 9 a.m. and you entered a long position by one lot at 1679.5. Okay, that is the price that you bought. Okay, because you already analyzed your chart, and then you assume that the chart, you speculate that the chart is gonna be bullish. Okay, so you entered one lot, and then on November 15th, you saw that this probably market has already reached its peak. Okay, reached its peak on November 15th. Okay, so in the span of about 7 days, okay, in the span of about 7 days, and then you hold a position for 7 days, and then you close your position at 1781.9. Okay, how much is the profit gain from this? This chart is based on FGLD itself. FGLD. Mr. Yu Long. Okay, so this is from FGLD actually. Do you know how to calculate? 1781.9 minus 1679.5. Or actually, you can see how much tick movement there is going from November 8th to November 15th at the time you close. So you can see here it's 1024 ticks. Okay. Now, how do you calculate the profit gain from this? 1024 ticks. Remember that every tick, okay, every 0.1 USD movement is 4 ringgit. All right, every 0.1 USD equals to 4 ringgit. So if it moves from 1679.5 all the way to 1781.9 equals to 1024 ticks, you times that with 4 ringgit, how much do you get? 10024 times 4. So you get 4. Right. 4096 ringgit. Okay, 4096 ringgit. Okay, so as part of having physical gold itself, another alternative for you to invest in gold is gold futures lah. Okay, so let's say you have after making an analysis of the chart, and then you assume that the gold is likely to increase, okay, to rise in price, and then you take a long position. Other than having the physical gold asset value going up, you can also as an alternative trade on the gold futures, and trade along with the direction of the gold that is going. Okay, so if you compare to the margin that margin of the FGLD, which is 1,700 ringgit, okay, and then you compare that with 7 days of holding the position on FGLD, you gain 4,096 ringgit. Okay, how much is the return of investment that you're getting from trading FGLD? Okay, so this is one side of the on the market investors under retails, okay, that want to speculate on the movement of the commodity. Okay, all right. So as I mentioned, the contract itself is based on the ICE benchmark administration reference price. Okay, so before we go to fundamental analysis, I need to make sure that everyone understands what is actually gold futures. I mean, if I go through quickly, I don't assume. I mean, if I show these revamped contract specifications, I believe it's quite technical lah. Okay, so going back to what futures itself, okay, the point of doing futures is to hedge. Okay, like for example, you want to buy let's say you want to, okay, at the time that when gold, you expect that when you consider all the fundamental factors and stuff, and then you hear that gold is starting to go down. Okay, let's say if you want to, let's make it easier here. Okay, by basing on the chart on gold futures under COMEX. Okay, this is for the sake of understanding what is the point of doing what is the point of having futures as part of under the investment. Okay, so let's say we take about around here, around March. Okay, the point of having futures is that when you, let's say you have an asset, okay, let's say you have an asset, for example, in this case, it's gold, and then you expected at this point at around 2000, okay, at around 2060 something, and then you started to see all the fundamental factors and everything. You expected that the price is going down. You have the underlying asset of the physical gold, and you're worried that the asset you have is going to lose value. Okay, let's say you buy a gold on March of 9 at the price around 2060, okay, and then at this point of time, then you start to hear a lot of rumors and everything that the market is going down. Okay, and then you read back from the analysis, and then on the fundamental factors, everything, you realize that market is going down. Okay, now you have a physical gold, and it's depreciating in value as the market goes by. Now, how do you protect your asset? How do you protect your asset? So how do you protect your asset is that is the point of having futures, because when you have these gold futures, you can hedge against the depreciation of your asset. Okay, so for example, you bought the gold at 2060, and then it's going, and then you see afterwards, after a few days after that, it start to depreciate. So at this point of time, you start to see that the general direction of gold is going down. Okay, it's going down, it's losing value. How do you take advantage of this? Is by selling futures contract. Okay, that is the point of having futures on managing your portfolio and your assets. Okay, so for example, let's say here you start to have all the bearish analysis, and then at this point of time you start to sell. Let's say you sell one lot at 1960. Okay, 1960.8. Okay, so when you sell on the contract, you have to remember that even if you when you have a bearish analysis and you want to gain profit from the bearish analysis, you sell. Okay, so for example, at this point of time, you see that the market is going down, and you still have that bearish view that the market will go down further. Now remember that the asset that you bought was here, and it's depreciating in value and going down further and further and further here. Okay, so basically what's happening here is you're losing value. You're having loss, basically. Okay, you're having loss here. Wait, hold on. 28. All right. Okay, so you took a short position, one lot going down. Okay, and then by seeing the movement that the chart is going, and then it starts to go down further. Okay, so even though your asset is depreciating in value, you are covering the depreciation by how? By taking a short position on futures gold. Okay, right? So this is an example of how you, that is the point of hedging using futures contract. Okay, this is similarly if you see in other commodities, like for example in FCPO. Okay, if you take example of FCPO, where there's a lot of I believe that FCPO is much more familiar to you guys. Okay, so like for example FCPO, the market players, okay, all the institutions that are producing and buying the CPO, when they hear that there is a lot of factors that is pushing the price down, what do? They sell. Okay, it's the same thing here. So you basically want to protect your asset by using futures contract. Okay, so at this point, when you, so let's say you by July 19th, you think this is probably where the market will start to form its base and will rebound, for example. Okay, will rebound, and then you want to close your position because you believe that the gold price will start to go up, and then will start to appreciate back its value back to the price that where you bought the gold, the physical gold at 2060. Okay, so you close your position and then you gain 2,659 ticks. Okay, so this is the example of futures trading. Is that clear? Because a lot of people is exposed to investment, a lot of is exposed to equities. Okay, equities trading, but not a lot of people understand exactly what is the point of doing the futures trading. So this FGLD offers an alternative for you to hedge against the movement of gold. Okay, when the gold price is going down, how do you hedge? You sell. Okay, also it's also the same way how fund managers protect their portfolio. Okay, let's say you have KLCI dropping. Okay, KLCI dropping because of COVID-19. Okay, let's say so let's say you on on 2020. Okay, so at this point, let's say if you on March of 18th, okay, earlier you heard all about the rumors about COVID-19 and stuff. And then you expect, you probably already expect that it's gonna hit the economy really hard, and then you're gonna see market crashing when it starts to take its form with during the COVID-19 lah. Okay, it drop all the way to 1,200. Okay, so how does a fund manager that is holding all these equities at this, let's say, during the February and January at this point, want to protect the portfolio? How? By, can you guess? You can do this as well, actually, especially for those that are trading stocks, and then you hear that market is crashing. What can you do? How do you want to protect your portfolio? FKLI. Okay, FKLI. Now, of course, this is a different contract lah, but I wanna this is important that you understand what is the point of trading the futures contract, especially when you trade gold. Okay, gold futures. So let's say you holding a position on equities, on stocks, probably whatever stock it is. Okay, whatever stock it is, you're holding stocks here, and then KLCI is dropping from 1,600 all the way to 1,200. How do you protect your losses? How? By trading futures itself. Okay, how do you protect? Is by taking a short position, by speculating that the contract is going down. Okay, FKLI, this is another contract under Bursa. Okay, you sell and then you buy back at the height, okay, at the peak of the COVID-19. Okay, your portfolio is losing this much. Okay, assuming that it is losing this much, but your short position is gaining. Okay, your short position is gaining. Gaining what? Gaining profit. Okay, from taking a short position. Okay, Mr. Marvin, that's correct. Okay, so okay, understand? Do you understand what is the point of futures? Because if I talk about all the contract specification, of course it's relevant, but what's more important is on how to take advantage on the futures contract itself. Okay, now the important thing that you need to take from this is that just that the multiplier is 40 and the trading hours is as such. Okay, and the minimum price fluctuation is 0.1. Okay, USD 0.1. Okay, so we'll go into the fundamental analysis of gold. Right, 1 second. Okay, so what are the key factors that are affecting gold price? Okay, so as you can see, there's a number of factors that I will be talking about tonight. As a trader, of course, the fundamental and technical will affect the gold price, but at this point, at the start of this webinar, we'll be talking on the fundamental first, and then on the second half of the webinar, we'll be talking about the technical factors that we see on how to speculate the movement of gold price. Okay, so fundamentally, okay, we want to see whether gold is able to maintain as a safe haven of investment. Okay, and we see from time to time, okay, as proven historically, gold does a great job at maintaining itself as a safe haven regardless of the economic crisis that is occurring globally, whether it's COVID-19, okay, as a global pandemic that hit the whole world like a rock and then give such a huge blow economically, or the Russia-Ukraine war that happened during the first half of the year and still yet not resolving. And we can see how gold is able to maintain itself and remain as a strong asset. Okay, strong asset of investment. So okay, so most of as I mentioned, most of examples that I'll be using in my webinar will be based on the COMEX gold price as a reference. though the FGLD settles, as I mentioned as well, using the ICE benchmark administration gold price. Okay. Now, let's look at the economic and global crisis. So in terms of global crisis, if you look historically, gold remains strong when it comes to economic trouble. And then a lot of fund flows back into gold and market as a safe haven. Okay. And then if you look at the inflationary environment is it's beneficial, of course, okay? Beneficial for gold, where gold is much more favored when you have a high inflation situation, okay, circumstance. What about US dollar value? Okay, US dollar, the index of the US dollar, it affects inversely proportional, whereby when the US dollar goes up, it affects the gold price and pushes it down. Okay, and the contract itself is traded on USD per troy ounce. Thus, when the USD is strong, it affects negatively. Okay, when the USD is weak, it affects positively to the gold price. What about the supply versus demand for gold? Okay, the basics of supply versus demand is that when the supply is higher than the demand, the price will go. When the supply is higher than demand, the price will go down. Okay, when the demand is higher than the supply, the price will go up. Okay, this is what you see in a lot of the commodities happening. You see in, for example, into the most familiar futures contract is FCPO. When you see the demand, like for example, strong demand from India with the upcoming Deepavali in India and the Golden Week in China, what happens to the FCPO? To the FCPO price, it shoots up. Okay. What happens to when you see that the supply in CPO is going down because of the COVID-19 and labor shortage? The price shoots up. What about gold? Okay, looking at the supply of gold, it doesn't move as what you see in other commodities. Okay, it's generally quite fixed and stagnant in the sense that you don't see a sudden surge or shoot up or suddenly dropping low in terms of mining production, recyclable gold supply for gold. Okay, but the demand of gold, on the other hand, is where the driving factor for the gold price. Okay, where you have the jewelry demand. Okay, you have all the investments, you have central bank purchases that affect the gold price. Okay, at times when the jewelry demand goes up, especially from India and China, what happens to gold? It drives the price up. Okay. Now, as I mentioned, looking at the supply and demand statistics, you see it's generally about, it's quite fixed. Okay, and then you have where does the supply of gold comes from? It comes from the mine production, it comes from the recycled gold. Okay, and then as in turn, from what you see on the screen, it doesn't move much. Okay, it's quite fixed. Okay, from year to year. All right. So if you look at the demand of gold, okay, so generally you can see that a huge part of it, it comes from jewelry demand. Okay, jewelry fabrication, from what you see here. Okay, the purple part. Okay, and the other part of it is from the investment in gold and from the central bank purchases. Okay, now from what we can see over the trends over the years, that it is starting to get more and more sluggish. Okay, because one of it is because of the rising interest rate that is hurting the gold price, because you need to understand that gold is an asset class where it is a non-interest bearing asset. Okay, that is why when the circumstance is where you have the high interest rates, investors will shift their asset in instruments that gain from the high interest rates environment, like for example in fixed income deposit, FD and such. Okay, and as you can see here, okay, from year to year, you can see that the jewelry consumption from as compared to the years before, it starts to become sluggish and goes down in trend. Okay, but mainly because of the how it affects economically because of the global pandemic. Okay, and then who are holding the biggest reserve in gold? And then as we can see here, is the United States of America, and then after that is the Germany, and then Italy and France. Okay, so these five, okay, these six, okay, USA, Germany, Italy, France, Russia, and China are the biggest that is holding the gold reserve in the world. Okay, the biggest being United States of America. Okay, so let's look at the inflation and interest rates. All right. So how does inflation and interest rates affect gold price? Okay, like for example, when you have let's look at the in the situation, in circumstance where you have a high inflation rate. Okay, what happens to gold? All right. So you need to understand that gold is being seen as a safe haven. Okay, when the inflation is high, investors, okay, people will start to move their assets assets and investments into a safe haven, which is gold. Okay, is compared to equities market. That is when you have inflation, you have all the stock market starts to crashing down. Okay, so how do you counter a high inflation environment? Okay, how do you save yourself from the high inflation environment? Is by moving your asset from another instrument that is much more safer. And if you can see, and if you can see historically, okay, if you see historically, from when the inflation level is becomes higher, you can see that the nominal returns of gold is actually increases proportionately. Okay, so the outcomes, the investment outcomes that you can see from gold is actually a lot better when the inflation is high. Okay, all right. Now, let's see how does an interest rates, okay, interest rates affect gold price. Okay, so in a high inflation environment, how do you counter in high inflation environment? Is by increasing the interest rates. Okay, so as you have been seeing for the past few months, okay, and then central banks are pressured to hike the interest rate for the inflation environment. Okay, so what happens when the interest rates goes up? They will move, as I mentioned, they will move their investment into other interest-bearing assets like bonds, okay, like and fixed income investments, yielding investments such as bonds and money market funds automatically become more attractive, because you need to remember that gold is a non-interest-bearing asset. Okay, that is the important reason why you see weakness in gold follows when the Federal Reserve raises its benchmark federal funds rate. Okay, and then as part of it as well, the stock market rather than the gold market suffers from the largest outflow of investment capital. Okay, when raising the interest rates, making the fixed income investment more attractive. Okay, so rising interest rates always lead to investors to rebalance their investment portfolios. All right. Now, what about the USD strength of the USD US dollar as compared to the gold price? Okay. All right. So dollar itself, okay, dollar itself serves as an instrument whereby you an asset instrument where you have a strong dollar environment. People will not generally will not invest in gold. Okay, so when dollar weakens, we see the demand for gold increase, and in turn, when you look at the chart, the price goes up inversely proportional to the movement of the USD strength. Okay, and the contract itself being USD denominated itself also affect the gold price, whereby the purchasing power does in fact inversely, okay, and pushes the price up, as we can see, as we see recently, where the USD starts to lose its strength. Okay, like from this chart, when you can see, when USD starts to go down, gold starts to rise up. Okay, USD goes up, gold goes down. Okay, USD goes weakens, gold strengthens. Okay, So it's the inverse. The relationship is inversely proportional to the movement of each other. Okay. All right. What about the economic and global crisis? What economic crisis do you know that affect the gold prices? Now, if you can see, okay, the correlation between looking at all the economic crisis and the global crisis that has been happening in the world, okay, we need to understand the most important thing is that the correlation of gold with the stock market as well, okay? And how does gold fare during the stock market crashes? So if you can see from this table that is gold is doing well when the equities are not are declining, okay? And if you look historically, okay, on the biggest declines in S&P 500, especially during the stock market crash in 2008, gold is faring very well, okay? When the stock market is crashing, where does the investors protect their investments? They move to gold, okay? That is then you see all the rebalancings of the portfolio going from equity shifting to gold. And then when the market is recovering, the rates are hiking. Where do they move? From gold, they shift their investment into an interest-bearing asset, okay? Into equities. All right, so that's why you can see that in times of economic turbulence, gold is favored as an asset class because and when you see in good times, investors will generally go into the equities market because it gives better returns, and equities as an asset class itself also gives dividends, but gold doesn't, okay? Because if you keep it in gold, it doesn't give any dividend or anything, okay? So similarly, when what happens in bad times, okay, when during all the stock market crashes and everything, investors will rebalance back their portfolio and move their asset from the equities and start to look for alternative where they can hedge against the declining market. Okay. Similarly, like when I give an example of how the fund managers can protect their portfolios, especially like for example during stock market collapses, during stock market crashes. How do they protect the portfolio is by taking advantage on the futures itself. Okay, but this is on the different view lah. Okay. All right. So as you can see here, this is if you can see that at the start of a recession, okay. Okay, at the start of a recession, at this point, okay, at this point, you can see that gold on the first 6 months, at the onset of economic crisis, gold performs well in the first 6 months compared to equities market, okay, at the start of recession, okay, as compared to the US stocks on the S&P lah, okay, and even after 1 year of recession, it still does quite well comparing to the equities, okay. So there's a lot more to talk about gold fundamental analysis or the fundamental factors that are affecting gold price, but these are the basics or the important things that you need to monitor, okay. You need to monitor and see when it comes to all the news and factors that are affecting gold price, okay. So now moving on the technical analysis of gold itself, okay. Of course, the chart that you see and what you see right now, FGLD on your charting platform and a trading platform, it doesn't have a lot of volume or liquidity as much as you see in FCPO, okay. And how you can analyze your chart, okay, your gold chart, in my opinion, my personal opinion, you have to, if you want to trade FGLD, you have to base your analysis from my experience by using the COMEX Gold Futures chart, okay? Because if you compare from the LBMA gold price, okay, if you compare the LBMA gold price with the FGLD, the movement is almost the same, okay? I'll share it here. Of course, you see on the chart, there isn't much to see in my opinion. That being because the contract doesn't have a lot of volume yet, okay? Like I think if you compare it like FVPO compared to FCPO, is you see the same thing, okay? So the counter, let's see, this is 3 minutes and this is 3 minutes. Okay, so this is, let's take it from second. It'll take 50 minutes. Okay, so I'll use a Heikin Nashi chart for the sake of easier for us to see the chart lah. Okay, now if you want to analyze technically on the gold chart, it's hard. Okay, even if you use the 50 minutes or 30 minutes or 1 hour, even if you use 1 hour itself, there's no properly formed candle you can see from the chart. Okay, even if you use at 4 hours, even if you use that daily actually. So that being said, because of the contract doesn't have a lot of volume, and then you see that a number of days, is few days that where the contract is not traded at all. Okay, like for example, from October 11th to all the way to October 17th, there's no contract traded at all. And then today we only have about 2 lot traded for FGLD. Okay, but nonetheless, the movement that you see in FGLD is about the same that you see under COMEX, okay, Commodity Exchange for gold futures. Okay, so let's say for example you take from September 28th, okay, September 28th. I'll change this to daily. Wow. September and 28th. Okay, now what you can see is it does mimic the movement that we see on FGLD and on gold futures under COMEX. Okay, so I think I saw a participant, one of the attendees that mentioned that FGLD is only traded twice today, and you expect us to trade these gold futures. I understand that point of view because I myself I myself is a trader, and I understand that the liquidity and the volume is needed for retail investors like us, okay, like you guys, like every one of us that are not trading under institutions, are trading on our own capacity. We need to have volume, because if we don't have volume in the contract, it will be hard for us to buy and sell. Okay, and the price that we get from the buy and sell of the contract itself will be very much skewed. Okay, I believe that Bursa is also doing its best to attract a lot more market players into the market, into FGLD. But for the retail investors, how you can take advantage of this is by making your analysis. Because as you see that the direction that is going under the gold FGLD is almost the same, like it's actually basically it's the same like the one that you see on gold, COMEX gold. Okay, so let's say if you make a very bullish analysis at this on this chart, and you want to enter long, but if you enter on COMEX Gold Futures, you will be exposed to all the USD and MOR currency conversion, and then you have to probably subscribe to other exchange under CME. Okay, that is a lot of hassle for you just to enter a position on COMEX Gold Futures. Okay, what you can do now is, because you have a gold futures contract under BMD, you can straight away buy. Okay, you say you have a long bullish analysis on the chart, you buy on the chart on FGLD, and then if you see that the market is starting to peak and reaches its probably you see a divergence or stuff or anything, and then you want to exit, and then you see the market will not be going up anymore, what you do is you sell. Okay, you sell accordingly to your analysis on COMEX. Okay, so let's say you buy here. Okay, let's say for example, on the COMEX gold chart, you see that market is probably forming a, what is this? Before you go into the technical analysis and learn more about this stuff, what is this? For those that have learned about technical analysis. Anyone? All right, never mind. We'll go into, okay. All right, Madam Izwandi, triple bottom. Okay, so you see that there is probably market is forming a triple bottom here. Okay, you see that market is probably forming a triple bottom here. So on November 7th, you're still not sure whether is it exactly a triple bottom or not. It can, by right, it can still break the support from the triple bottom and go lower, right? Okay, so what you want to see here is whether it can rebound from the triple bottom and go higher. Okay, right. So, and then you start to see that the market has started to break out from this clear zone of support. Okay, of course, the next level of resistance is here lah. Okay, and then from the neckline of the triple bottom is here, and then if you take it even further, you probably can see as well this is a cup and handle. Okay, so this being the neckline. Okay, so let's say you entered the position, okay, seeing that market is probably forming a triple bottom and you want to enter a long position here. Okay, you want to enter a long position here and you entered on November 8th. Okay, so you see from the analysis here that on November 8th market is starting to go up. Okay, so what you do is, because you don't want to trade under COMEX gold futures, because FGLD is available to you, what you do is on November 8th, okay, you're using the same pointer. So here you enter a long position. Okay, you entered a long position. So at this point, you entered a long position, but you're not sure how to analyze the market, the direction of the market here on FGLD. Because I mean, if you see the chart itself, there's no volume here, right? Like you see here on November 11th, there's only one lot is traded. November 14th is only one lot traded, and then there you have 4 lots traded. But what you want to do is, you don't want to be trading like this. You don't want to analyze by this. You want to analyze by analyzing its counterpart. Okay, which is the COMEX gold. So let's say here you assume that the market at this point, okay, 2 days later, you see that market has broke out. Okay, at this point it breaks out. One from the triple bottom, and then another one is from the possible cup and handle that you're seeing here. Okay, we'll see about all the technical later. This is just an example on how you want to trade the gold futures. Okay, Now, market has already break out, right? And then at this point of time, you hold a position here. At this point of time, you see that on November 23rd, you see that it is probably, because you see that this is a cup and handle, okay? And then you see the neckline being the resistance. This is resistance becoming support, okay? And when the price reaches to support, what happens? It will rebound, okay? We expect it to rebound. So let's say it rebounds. Okay, it successfully rebounds and you think this is the maximum that the gold will go. From your analysis on COMEX, this on December 1st is the highest price that gold can go. Okay, assuming let's say we speculate that on December 1st is is as far as it can go. Probably it peaked during that day. Okay, so let's say on December 1st, you decide to close your position. Okay, so we'll draw a same line. Okay, so let's say you on your analysis of gold futures under COMEX, you decide to close your position, and this is how much you got. Okay, let's say probably in the middle. Okay, so how much you get? About 890 ticks. How much is 890 ticks? Remember that the margin is, how much is the margin? RM1700. Okay, 890 ticks. Let's count times 4. How much? RM3560. Okay, this is how much you get from taking your long position on gold futures on FGLD. Okay, so of course, as I mentioned, it's not for you to exactly per se to look only at the FGLD. Okay, because the chart is not very well formed compared to its counterpart. Okay, so if you want to trade FGLD, the best way is to base your analysis on COMEX gold. Okay, now let's learn about what are the basic tenets of the technical analysis that we're going to apply on gold, because those that are trading futures, okay, those that are trading futures in mostly are speculators, okay, especially us we are the market investors, okay, the market retailers. Most of us are speculators on the futures contract, especially on the FCPO. You see a lot of people that are doing speculation whether it's going up or down on FCPO, right? So you need to understand the basics of the technical analysis itself, because there's a lot of things that comprise under technical analysis. You have all the Elliott wave, you have the Wyckoff theories and everything, but the basics are the most important. Okay, the first one is the market discounts everything. What does it mean? Okay, so what does market discounts everything? Discounts everything is that the price is always the leading indicator to all the fundamental factors that you see. So, like for example, let's change back to let's use gold. Oh no, let's use COMEX gold because the chart is much better. Okay, so let's say you at the start of the Russia-Ukraine war, okay, around here, okay, February 3rd. Do you remember when did Russia declares that they are going war with Ukraine? It was much later in February, okay, much later in February, around February 28th, and going on to the early March. Okay, So what happens to the chart is that when you say that the market discounts everything, the market has already moved accordingly to the bullish factor. Okay, it breaks. Okay, as you can see here that it finally breaks the sideways movement going from June all the way for how many months is this? 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 months of sideways, and then finally on February at the mid-February, at the start of the war, gold has already start to peak. Okay, start to go into a bullish uptrend. Okay. Okay, so before war break itself, okay, gold has already moved. Okay, this is what you say about that's what it means about market discounts everything. Like you can take it under in the equity point of view, where you frequently hear about buy on rumor and sell on news, right? Market has already moved before the news come out. Okay, so another one is price always move in trends and counter trends. It doesn't move randomly. Okay, and then the price action that you see, like the triple bottom, double bottom, harami, all the doji and stuff, it's repetitive. Okay, the action of the price is repetitive, reoccurring patterns. Okay, to understand about the technical analysis, you need to understand 5 things. Okay, the first one being candlestick, the second one being support and resistance, the third one being market structure, and then trend line as well, and then the final one is chart pattern. Okay, not taking in consideration about all the advanced technical analysis like Elliott wave, like Wyckoff, okay, like Fibonacci trading, okay, and all the advanced theories. What you need to understand is this all this. Only 5. Okay, don't make it too complicated when you want to analyze your chart. Okay, don't make it complicated, make it simple. When you want to analyze your chart, whether it's gold, whether it's future FGLD, whether it's FCPO, whether it's FEPO, whether it's crude oil, always based on these 5 basic things. All the classes that you see that are selling thousands, or probably 5-figure classes or 6-figure classes, you probably see. I can guarantee you that the basics is always this 5. Okay, so going one by one, the first one being the candlestick, you need to understand what does it mean by the OHLC, okay, by the opening price, the closing price, high price and low price. How does it affect the price movement? What happens when price that you see on the market breaks the intraday high? Okay, what happens when it breaks the low? What happens when it breaks the previous high? What happens when the price reaches back to the closing price? Okay, all these are important. So what's important in the behind the candlestick is that you understand the buying pressure and selling pressure. Okay, I see that a lot of people before we go into that, right? I think probably those that have already started learning about candlestick, you will see all the chart patterns like doji, like harami, like engulfing, like the morning star, evening star, all this stuff. And then you think there's a lot of things that you need to remember. But in fact, to make it simple for you to understand is simply by looking at the buying and selling pressure. Okay, let's say a market opens here. Okay, and then market goes by, and then it forms its high here. Okay, it forms its low here and closes here. What is the color of the candlestick? It opens below and closes high, but it doesn't exceed the high, but it doesn't exceed the low. Green. Okay, green. Next one. What if it opens above at 0, at here? Okay, and then goes down and then closes below, still below the opening price. Bearish candle, right? Okay. What happens if the candle opens at here, goes all the way here, and then all the way down, and then goes back up again to the same opening price? What is the candle? How do you think the candle would look like? Okay, it's doji. Okay, so what's important that you understand from here and here is that what is the pressure? What is the dominant pressure that you see from here? It opens below and then it pushes up and then it pushes down, and then it pushes back out again. What is the dominating pressure here? Buy or sell? Buy. All right. So buy. Buy is stronger than sell. What happens when it opens high, goes push up and then push all the way down and it closes below the opening price? What is the dominating pressure here? Sell. Okay, sell is stronger than buy. When you see this kind of chart, it opens in the middle and then it pushes back up and then it pushes all the way down and then it pushes back all the way to opening price. What is the dominating pressure here? None, correct. Okay, it's even. Okay, it's even. Okay, and what candle you see? You see a doji. Okay, when you see this, let's say if you if this comes from three strong bearish candle, so assuming a market has been going all the way down, okay, falling down so far from 3 previous days, and then suddenly on this day, okay, this is what the pressure, what pressure is dominating? It's the selling pressure. Okay, selling pressure is stronger than buy, and then suddenly you see a doji, and then as we discussed just now, it's even, sell equals to buy. Now, when you see this, what do you expect market will happen after that? What is the expected reaction? Okay, so you expect a reversal. Okay, you expect, it's not in terms of the pressure, you expect that there is a possibility that buying pressure will start to dominate the selling pressure. Okay, now this one opens high and then it push back down and then it reaches back to the opening price and it push back down again and then buy all the way, push all the way to the opening price and close at the same price. What is the dominating pressure here? Okay, it's buy. Okay, buy is the dominating pressure here. So when you see that market is start to going down, push all the way down, and then suddenly market is doing like this. It pushes down, but then it rebounds. It pushes down again, but it rebounds back all the way to the opening price. So what's the expected reaction when you see after that is that market is possibly will be going up again. Okay. All right. Now, what about this one? It opens at the bottom, okay, and then pushes back all the way, push back all and forming this top high, okay, and then it retraces back and push back all the way down to the opening price. What is the dominating pressure here? Sell. Okay, sell is stronger than buy. Now, even if you don't remember what is the name of this candle, do you know what is the expected reaction after that? Even if you don't know what is the name of the candle, Okay, so of course, when you see, let's say market has been going in uptrend by all the way from here, and then suddenly it gives this kind of candle, we expect that this buy on this candle, buyers, okay, the buyers going to be overly dominated by the sellers, okay, and at that point of time you can expect that the market will be going down to them, okay. And similarly for this Marubozu, okay, whether it's pushing all the way down or whether it's pushing all the way up. Similarly, when you see in equities, right, you probably heard about song by DNK making songs about Marubozu and everyone all in and stuff, okay. So what's important is, even if you don't know the name of this candle, all the patterns that you see, what's important is you understand what is the pressure, dominating pressure. Okay, now then you go to the support and resistance of okay. It's best to understand this by this one, okay. I always share this with my clients to understand what are supports and resistance. Okay, so for example, like this is resistance, right? So when market has breakout, okay, and then it retraces back to the same level of the resistance, what does this zone becomes RBS, okay. Resistance becomes support, okay. Similarly if it's in a downtrend, okay, if it's in a downtrend, the support will become resistance, okay. So what are the important characteristics of support and resistance that you need to keep in mind, okay? There are 8 things. You need to understand that support and resistance is not a price point. It's not like you pick a single level, it's gonna be the support that will be forming for the rest of the session or the rest of the month, okay? It's an area, it's a zone, okay? And the zones, the support and resistance is like they get better when every time it's tested, the longer it is, okay, and every time it is tested, the better it is, okay, the stronger the level of support and resistance is, okay. Zones are spots on the chart where the price reverses repeatedly, okay. Like for example, when we see the COMEX gold chart, when it forms a triple bottom, right, forms a triple bottom, every time it reaches that spot on the chart, it rebounds, okay. Then you know that exactly that there is a strong support zone on that level, okay. Zones may be extreme highs or lows on the chart. Zones are where naked traders find trading opportunities, and they rarely need to be modified, okay. You don't have to keep drawing your zone. Today you draw one zone, and then the next day you draw another zone, and then the next day you add another zone, and then the next day you delete this zone, or you erase this zone, and then you add another zone. It's not like that, okay. Zones, the support and resistance rarely need to be modified, okay. All right, so the next thing is market structure. We will test all this later on, okay, when we doing our practice, okay. So market structure is when market breakout, okay, whether it's in uptrend, what happens is it's going to make a higher high and higher low, okay. Let's say from this sideway, right, it break out from this sideway, okay, break out from this sideway, higher high, higher low, higher high, higher low, higher high, higher low, until when? Until it reaches its peak, okay, until it reaches its peak and it starts to break this market structure, and what happens is it becomes a downtrend. This becomes a high, low, 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 high, low, 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 high, low, low. If there is no higher high, or if there is no lower low, what happens? It becomes this sideway, okay. This is the low, this is the high, this is the low, this is the high. There is no point where it is higher than the previous peak, or there is no point where it is lower than the previous low, okay. This is important because if you can see that the zones are extreme highs or lows on the chart. Now, Okay, before you go to the practice part, okay, the chart patterns that you need to remember is only a few. You don't have to remember everything. You need to remember a few only. Okay, double top, double bottom, the head and shoulders, and the pennants. Okay, the pennants and rectangles and the wedge are basically the same lah. Okay, so you don't have to remember everything, because if you remember everything when you want to apply back on the chart, it's going to be confusing. Okay, all right. Now let's do a very quick practice. Okay, very quick practice. Now market on March 8th, it dropped all the way from around 2060 here, okay, all the way to November 8th, all the way down to almost 1,600. Okay, what you can see from, maybe I should actually let's see. Right, we'll just do it straight away on the chart. Now, if you remember from the slide, okay, when the market is in downtrend, it forms a lower low, lower high, lower low, lower high, and lower low. Okay, so if you see on the chart, what is this? This is market moving in a downtrend. Okay, market moving in a downtrend. If you change it to line chart, it will look much better. Okay, although maybe it's not really in my opinion, I think it's really clear for how you can see the market structure. Okay, so at this part, okay, this probably is where it's high, and then this is the lower low, lower high, lower low, lower high, lower low, lower high, lower low. Okay, at what point do you think that the market will start to reverse, break its downtrend? Can? Okay, so what you expect is, if the market can, okay, if the market can break the previous low high, okay, this is the lower high, right? This is the lower high, this is the lower low, this is the lower low, lower low, lower high. Okay, if it can break this level, okay, if it can break this level, then you're gonna expect that the market will start to go uptrend. Okay, now if we take the chart to the right, and this is where you see at which point do you see the signal that the market will start to go uptrend? Here. Okay, this is the signal that the market will go uptrend. You see this repeating again and again at all the markets. You can see this happening in FCPO, you can see this happening in the equities market. Okay, this is the first signal that the market will start to reverse. Okay, right, and at the same point as well, okay, if you remember that zone are supposed to be the extreme highs and lows. Okay, at this point is where the market rebounds. Okay, okay, can you see the chart? Okay, never mind, we'll go to the next chart. Okay, okay, semua. Okay, thank you so much, Mr. Muhtar. Okay, so for the same chart that we see just now, okay, we see that we did our analysis that there is a triple bottom, right? Okay, there is a triple bottom. Okay, triple bottom, then you expect that market will possibly start to move higher. Okay, this is the first signal. You actually can know it much earlier, before it even moves uptrend earlier. Okay, all right, that is one of the thing that you can, that is why it's important for you to understand that the basic things like the technical the candlesticks, the chart patterns, the market structure is important for you to analyze your chart. Okay. Similarly, for example, like this. Okay, market has been going downtrend. Okay, if you remember from my support and resistance slide, zones are the extreme highs and lows. Okay, so this is the low, 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 high. This is the low. Now, where do you expect the low high is gonna be? It's gonna be around the low low. It's possible. Of course, it's possible that it can go shoot up higher, but generally you expect that the previous low low will be acting like a form of support, okay, to the chart. Okay, so if this was support, what is this? This becomes a resistance. Okay, this becomes resistance, and where this is the SBR. Okay, you call it as a SBR. And if you, even if you apply some more advanced technical analysis, and then you draw out probably a Fibonacci retracement levels, and then I can guarantee you this probably also will retrace around 0.5 to 6.18 levels here. Okay, 18. Okay, so hold on, one more. I think there's a few more charts that we can analyze so that we understand the technical analysis on the. One moment. All right. Okay. Let's try to practice a simple technical analysis here. Where is the resistance, do you think? Where is the resistance? Would it be fine if I say that resistance is somewhere here? Also, the 1,700 acting as a psychological resistance as well. Now, what do you think will happen if the market successfully able to break this level of resistance? Now, you remember that the price has the market has already tested here once, and then tested again here twice, and then tested again 3 times, unable to break the 1,700 level. If it breaks, what do you think is going to happen? Reply. Okay, let's try. See. Okay. At which point of time that it retraces back? Okay, it retraces back to the level of the support, to the resistance, and then it breaks out again and move higher. Okay. Now the same level, okay, if you can see that the same level, okay, the same level acting as a support when it breaks out. Okay. So when do you know that this level will be a support? You know from here. This one and this one. 3 times earlier that you knew that it's gonna be a support. Okay. So okay, of course, if you want to calculate your profit and loss from this COMEX, it wouldn't be accurate lah. Okay, because we're talking about FGLD, right? So let's say, let's put side by side lah. Let's put side by side on how you can use to your advantage for the gold futures, FGLD, and the analysis that you do in COMEX. Okay. FGLD. Okay. So as I mentioned earlier, at the start of when I share about the technical analysis. So this is how you analyze your chart. Okay. So if you want to trade FGLD, always base your analysis on COMEX. All right. I think we've already reached to our ending of the webinar actually.
Yes, that's right. So if any question, please write your question in the Q&A box. We'll just do a brief Q&A session. Is it okay, Dr. Arif?
Okay, right, sure.
To extend a bit to do a short Q&A.
Okay, let me, if you have any questions, you can write on the chat box. I'll
All
read
right.
questions
We
here.
see one question by Sam is that if FGLD mimics COMEX Gold, would there be a lag in FGLD?
Then isn't okay. To Mr. Sam, if FGLD is mimic COMEX Gold, so there should be a lag in FGLD. Okay, no, it's not. Because the movement of the FGLD, because when you want to analyze the movement of gold chart, right? As I mentioned, you should, in my personal opinion, you should base your analysis from the COMEX Gold. But it doesn't, when you want to trade FGLD, it doesn't lag to the movement that you see in COMEX. Okay, it goes together. Because if you see that the market is starting to go up on your analysis in COMEX, FGLD will go together. Okay, FGLD go together with the direction that the COMEX is going. COMEX gold futures is going. Okay, so it doesn't mean that if you trade FGLD, it's lagging to the direction that is going on in FGLD. Right, under COMEX gold futures. So in that sense, it doesn't actually give you advantage whereby you can enter earlier on FGLD. No, it's not like that. And then also you need to take into account that the liquidity that you have in gold futures, okay, liquidity that you have in gold futures in FGLD is very low. Okay, it's not like gold futures that you have in COMEX, which is a much more liquid contract lah. Okay, so you need to take into account wherever you get in FGLD will probably not be the same as the price that you get under COMEX gold futures. Okay, I think there's another question that someone asked in the chat box. Mr.
Right.
Peter Ho. Okay. How do I identify the technical analysis signal is real signal or fake false signal or not? Okay. How do you want you? Okay, you need to understand that when you want to analyze your chart. Okay, Mr. Peter. This to answer the question by Mr. Peter Ho. When you analyze your chart, you can only speculate and you can assume from all the knowledge that you have, or all the analysis knowledge that you have, and doing the analysis, you can only assume. Okay, you have to accept that you can only assume, and you cannot actually know where the price will go, whether the price will go correctly into a nice uptrend, whether the price will go into a correction downtrend. No one knows. Okay, whether the breakout is real or not, whether the breakout is false or not, nobody knows. You need to understand that even if you know the PDT, okay, proprietary day traders, all the professional traders, okay, they also get trapped by the false signals, okay, for fake breakout and stuff. So it doesn't mean that even if what's important is that you make your analysis and you make the trading plan from it, and you manage your risk, because you need to understand that futures, especially when you trade gold futures, the risk is high. Okay, when the risk is high, you need to manage your loss properly. Mr. Tariq Faisal, why would we want to trade FGLD when we can trade COMEX gold directly and there is more volume in that market? Okay, as I mentioned, I think I've already answered this question already. Of course, when you want to trade the futures, instrument that is high risk instruments like futures, you need to trade a contract, okay, where it has a lot of liquidity and volume. Why you want to trade FGLD? Okay, this is important because I understand that from the speculative retail investors' point of view, because I myself is a retail trader. Why should I trade FGLD? compared to a more liquid and more contract that has more volume like COMEX Gold Futures. The reason being is gold futures, okay, FGLD, as I mentioned earlier during the contract specification, is not exposed to the USD MRR currency conversion exchange rate, okay. And then another thing is it is available to under BMD products, okay. When you open your trading account, you open your derivative trading account under any brokers, they will usually will give free market data and free access to BMD products. And now that FGLD being under one of the BMD products, you don't have to subscribe to CME, okay? Because when you want to trade gold futures under COMEX, you need to convert. That is one thing, okay? You need to convert, and you will be exposed to the USD MRR as USD ringgit conversion rate. That is one. Another thing is, if you take it on the cost basis, you also have to pay for the CME subscription price. Okay, if I'm not mistaken, it's about 12 USD. Okay, so without going through the hassle, okay, without having to exchange, convert your capital to USD, and then without needing to subscribe for live market data under CME to access to gold futures under COMEX, you can straight away trade under gold, FGLD under BMD. Okay. So even though there is, as I mentioned, even though there is not much volume from the FGLD, right? I understand that there are certain days that there's no volume even traded in the contract, which is it's dangerous lah. Okay, it's dangerous to the investors. But if you get the direction correct, okay, as I mentioned, like if you saw the triple bottom, and then you see the market is starting to break from its downtrend, and then you see market is going in a bullish direction, and then you enter a long position on November 8th. You make your analysis on gold futures, but you entered here, okay, and then you sell back here. By making your analysis on CME, COMEX gold futures, you can still gain profit under BMD, FGLD. Okay, I hope you get the I hope you get the reasoning why you should trade FGLD lah. Because I myself understand why you need to trade the higher volume and more liquid contract. I understand, Mr. Tariq. Okay.
Thanks, Dr. Arif.
Maybe one more.
Okay, sure. Yeah, I just want to highlight that, of course, the liquidity and the volume is a chicken and egg issue, right? The exchange is doing the best to educate the public about this product. So as more people are aware about the existence of this product and how to use that, then the volume will come in. Okay, because this is a revamped contract and not many people are aware that it has been relaunched. So I guess we are doing everything we can to share the awareness of the public so that the investors know that they can use this instrument to hedge their gold exposure risk.
Great,
right?
Totally agree.
Yeah. So what is the average range of the tick movement of FGLD, Dr. Arif?
Okay.
On a daily basis.
It's hard to it's hard to say because on certain days there isn't any lot traded, any contract traded on certain days. Like you see, like on October 12th all the way to October 17th, there's no contract traded, so there's no tick movement that you can see. But what's important here is when the market moves, it moves in tandem together with the CME gold futures. Okay, like for example, when you see market in CME, it's about 1680. Let's say it's 1678. When as a reference, okay, as a reference for CME gold price, the market goes up all the way to 1790. It goes together. Okay, 1790, it goes together. When you see the market goes up on the gold charts, or the all the global gold chart or the spot gold charts move up, the market will go up. Okay, what's important is I can't say exactly what is the minimum range of tick movement of FGLD on daily basis, because on certain days it doesn't move. Okay, because no contract traded at all. But when the gold price starts to move, it will move honestly. Okay, it will move it will honestly move lah. Okay, it will move properly and in with the correct trend that it should be moving. Okay, so for example, it reaches all the way to 1790. FGLD also reaches all the way to 1790. Okay, it's almost 1780, where probably about 10 ticks difference.
All right. Okay, I think that shall conclude our question and answer session with Dr. Arif. Thank you so much. Let me proceed to share my screen.
Okay.
So the good news from this webinar is that we're also giving away a Touch and Go e-wallet regular pin worth 30 ringgit. So this is giving to about 10 lucky respondents who answer our survey questionnaire. This survey questionnaire will be launched after this webinar and will also be sent to you via email. So we'll reach out to the lucky winners within 2 weeks. So I believe that many of you here would have won it before. And of course, you can still attempt it again. So if you can see, we will walk away with another 30 ringgit. Okay, please respond to our webinar survey so we know what do you feel about this program and whether has it added value to you. Okay, do let us know. And we also have campaigns for FM70. This is FM70, Trade FM70 and Win trading competition. So for the retail trading category, it is under retail trading competition. The first place will get 4,000, followed by second place 2,005, followed by 1,005, 1,000 ringgit and 500 ringgit for the fifth place. So the more you trade FM70, the more that you can stand a chance to win some cash prizes by BMD. All right. So the end of this campaign will be 31st of December. And of course, if you don't want to trade FM70, you don't want to participate in the campaign, you may also join this FM70 quiz challenge, whereby we'll be giving away 100 ringgit for 24 winners who answer the quiz questions correctly on the Bursa Malaysia Facebook page. Okay, do check out the Facebook page to answer the FM70 quiz challenge to stand a chance to win 100 ringgit. And last but not least, if you want to learn more about derivatives, you can head on to www.sidc.com.my to go through the derivative e-learning series. So that's where you can understand, the fundamentals of derivatives. What are the factors, okay, that cause the changes in the futures contracts of FKLI or FCPO and so on, and what are technical analysis involved in trading futures, and how you can use futures to meet your financial objective. All right, so you can get all this education and knowledge through this derivative e-learning series brought to you by SIDC. All right, so that shall conclude our webinar on FGLD today. So I hope that all of you here have learned enormously about how do you trade gold futures contract and what is the purpose and what are the benefits of trading FGLD. So thank you everybody for tuning into this session, and thank you so much to Dr. Arif for sharing with us how do we trade FGLD, what are the contract specs, what are the fundamental factors that can cause the prices to change, and how do you use technical analysis on FGLD. I like the fact that you also do comparison with COMEX Gold. Thank you so much, Doctor.
Right. Thank you so much from my side as well. Thank to Shane and to Bursa and to everyone that is joining tonight. Thank you for tuning in. And if you have any questions, you can always reach me on email or Telegram.
All right. So have a great rest of the day, guys. Okay, bye.
All right.
See you in our next session.